afternoon, everyone. Thank you for joining us to the Mars Business Cabinet Mid-Year Economic and Market Outlook. I'm Megan Hunter, President and CEO of the Mars County Chamber of Commerce. We welcome John Longo. Presentation from him. He's the Chief Investment Officer of Beacon Trust, which is a part of Provident Bank. So we thank you, John, for being with us today. Jack, would you like to say a few words of welcome?
I got to get off mute. No, yeah, thank you, Megan. Thank you, John, again, and thanks everyone for joining us. When we were talking about speakers, I just had a brief side shot with John, just saying with all the money that's being spent and the impact on the business community that the virus has had and where we're going and all, I just thought it would be just for me personally, I would love to get John's view of the world and because I think we're certainly in uncertain times, and I'm not sure we'll ever be back to where we were, but what do things look like going forward? So John, thank you.
Great. Well, thanks so much for having me, Megan, Jack, and I don't know if Tom's going to join us. It's my pleasure. As Megan mentioned, I'm kind of the CIO of Beacon Trust. Beacon is a subsidiary of Provident Bank. So I know most of you know Tom Lyons, who I kind of work with. And we manage about $4 billion, primarily for high net worth investors, but also we have institutional investors as well. And I kind of wear a second hat. I work as a professor. I went to Rutgers and I've been affiliated with Rutgers for well over 20 years as a faculty member. And I also teach one class a year in Columbia's Global Executive MBA program. Before COVID, that program would put me in China at least once or twice a year, primarily in Hong Kong and Shanghai, and I am in touch with people from around the world. The program is also a joint venture with London Business School, so I talk to people in the UK sort of on a weekly basis. So I'm going to kind of talk about what I call the big three: the economy, the stock market, bond market. Those are kind of the big three questions that people are typically focused on in a financial context. And I'm mostly going to share with you a bunch of pictures and graphs and just kind of have some commentary on top of that. I know Megan has my slideshow available afterwards, so feel free to request that. As I said, I teach, so I'm used to having people ask questions at any point. So you're welcome to jump in at any point, wait till the end, whatever you're comfortable speaking with. So I'm just going to get into the pictures. As I said, I have like an executive summary and things if you want to look at it afterwards. But let's talk first about the economy. And I think we all feel we're not quite back to normal, whether it's wearing the masks or certain restrictions. And, if you joined us before we officially kicked off, we were chatting about that younger kids have not yet been able to get vaccinated. So CNN, their business section they've created this back to normal index. And as you can see here, it's a function of 37 different sub-indices. And overall, nationally, the number's around 90, 91, and New Jersey right around that average. We see some of the states like the Dakotas and Idaho, they're actually even better than where we were, let's say, a year and a half ago before the pandemic started. And some of this will have a correlation with the vaccinations. I have a map of that. I think New Jersey is doing a pretty good job, not good enough, but relative to some other states, we're doing a decent job. This is some micro level detail data. We call it high frequency data. As an example, you may not know this, but your credit card data is being sold in an anonymous fashion to investment funds and other types of groups where they aggregate the data. So I think some of us are a little bit still squeamish about maybe traveling. I was hoping to take a trip overseas. That's kind of greatly restricted. So I've been doing these local vacations where I'm driving. So consumer spending is up. I'm going to share with you some data on that. A lot of it is that because we're kind of still somewhat in our homes and we're saving a lot, we're still spending as well on Amazon and other things. But you can see, seated diners, that's down about 15% from where we were before the pandemic started. At the depths of the pandemic, it was clearly banned. At TSA, you were only able to travel for an emergency. And I did take a trip a couple of weeks ago to visit my in-laws in Atlanta. The plane was reasonably full, but things aren't quite back to normal. So the way I would describe it is that for some people, it's the best of times. For others, it's the worst of times. We're doing this call, obviously, on Zoom. They've done phenomenally well. Amazon's done really well. But firms like Boeing and airlines and a mix of others, maybe some of the industries that you all work in, are not back to normal. So making some good progress. And by the way, I'll share with you a lot of these sources that I use in my data, because most of them are free, and you're welcome to bookmark them and just kind of check out on your own. So this one is from a resource called JP Morgan Guide to the Markets. And it's basically a book of macro charts. Another website you might be interested in, this is run out of some professors at Harvard. It's called Tracktherecovery.org. And the advantage of this website is that, once again, they try to get real-time data. You get data, for example, from GPS data. You can get it from credit card data. There are other sources as well. And I think this data is more timely than some of the government reports. So as an example, the unemployment numbers come out once a month. So what's interesting about this is that you're able to drill down on specific regions. And here, I actually clicked on Morris County, which is obviously near and dear to everyone's heart on this call. And consumer spending has been up quite a bit since we entered the pandemic. You can see the plunge here, down 40%, because you're living in your home. But now people have money to spend. We're going to talk about inflation. And if you tried to buy a car lately, maybe you've had some sticker shock. So spending is good. This is good for the economy, good for New Jersey. I'd say New Jersey is probably a bit above average, but this is just some interesting data. And you can see here, you can click on specific industries that are germane to what you do or where you focus, and even zip codes. So I would encourage you to kind of check out this website on your own. But overall, things are looking pretty good for New Jersey. I'm in the camp that the economy will continue to expand, that we're not headed for a second recession anytime soon, notwithstanding some of the spike in the COVID Delta variant. Now, this is something I alluded to, in that we're making some progress towards herd immunity. We're not quite there yet, mainly because of the unvaccinated. But let's look on the left-hand side of the screen here. We have some people that were vaccinated and not yet infected. Knock on wood, I think I'm in that category. I got the Pfizer vaccine as soon as I was able to get it. We've had some people that have had those breakthrough categories. And then yet we've had some people that haven't quite been vaccinated. So I'll chat a little bit about some of the progress that's being made in, let's call it, quote unquote, forced vaccinations. I mentioned I teach at Rutgers. We've required all of our students to be vaccinated unless there's some type of health type emergency. As I mentioned, you can see here the states on the East Coast tend to have a higher vaccination rate. Vermont is among the highest, and these numbers keep going up. But you can see here there are big segments of the country that still are even in the less than 50% range. And granted, we know the vaccine's not yet approved for under 12, but that is, Pfizer made some remarks that they're making some good progress on that. But based on Dr. Fauci's comments, we need this number to get, well into the 80s to have a greater comfort. But the data, in erratic fashion, is inching in the right direction. That's how I describe it. So when I look at the economy, I look at dozens of indicators, but I tend to place more weight on forward-looking indicators as opposed to something that just measures what's happened in the past. And I'll share with you two or three. One is called the Conference Board's Leading Economic Index. And this is a basket of 10 indexes, things like factory worker hours, unemployment, credit spreads. The S&P 500 is one of these. And the gray area of the graph just kind of shows recessionary periods. And in most cases, it goes down before we enter the recession. Now, This COVID recession happened so quickly. It was one of the fastest on record, and we exited it very quickly as well. But you can see the inset at the bottom of the screen. If anything, economic activity is picking up a little bit. So at least according to this indicator, no sign of a double dip recession. Another trade group that you may have heard of is called the Institute for Supply Chain Management. They do a monthly survey of what you call buyers or purchasing managers. So I think we're all kind of familiar with somebody that maybe works for a company and buys their inventory or whatever their plan is. And they have a manufacturing survey and then a services survey, which I'll show you on the next slide. So manufacturing obviously would include things like the auto industry, defense, oil and gas. There's a ton of manufacturing that still takes place in the US, despite a lot that's been outsourced to China. And how you interpret the graph is that anything greater than 50 signifies expansion. During the recession, these numbers were in the 40 range. So they've come down a little bit from the peak a few months ago, but these are still very healthy numbers for the manufacturing side of the economy. Looking towards services, I work in services, financial services, educational services. Some elements of healthcare would be considered service as well. And those numbers are also looking pretty good. Once again, anything greater than 50 signifies expansion. We see some healthy numbers here. These numbers were in the 40s. So Abby Joseph Cohen from Goldman had this analogy, and she called it super tanker America. That America, because it's so diverse in its industries, population, wealth, it's hard to really move the ship. And now the ship is moving in the right direction. So once again, I don't see any imminent sign of a double dip recession, despite the uptick in some of the COVID variants that we're seeing. Another thing that can set off a recession, and obviously I work with a bank, and Tom oversees a lot of the lending, is a credit crunch. And this is data from the Fed. And what you'll notice here is that when we first hit the pandemic, there was a huge spike in lending. And what happened here is that companies were fully tapping their lines of credit because they didn't know this is a once in 100-year event. There was a lot of fear and panic. I follow the stock market closely, and the next segment of my presentation will discuss the stock market. The stock market fell 30% in 1 month. That was quite unsettling. And in hindsight, the advice we gave to our clients worked out. Our advice is have enough to have 1 year of living expenses in cash. And then besides that, just stay the course with your diversified portfolio that was overweight equity. So that turned out to be good advice in retrospect, but there was a lot of fear there. As the Fed jumped in, as the government spending jumped in, fear kind of dissipated a little bit.
Are you still in here touching my ear? Well, there.
Oops. As the Fed jumped in, as government spending jumped in, we saw, let's say, some of that fear dissipate, and you were able to get money from your bank. So bottom line, banks are still lending. There's no credit crunch, which is also often a precursor to a recession. Inflation, I think, is in the headlines. I'm a little bit concerned with it. I'll share with you my views. I'm in the view that inflation is higher than what the Fed expects, but I'm in the camp that inflation will be elevated for, let's say, 1 to 2 years, and not like the 70s or 80s style inflation. So we see the numbers accelerating, and I can give you some context on this. So there's two parts to this inflation number. One is, we call it the base effect. So the numbers that we see in the CPI are on what we call a 12-month kind of moving window. So about a year ago, if you wanted a hotel room, you could probably get one at a great discount. Those discounts are gradually going away. So how I'll describe it is that of this, let's say, call it 5% and change number, half of it is due to this base effect, these abnormally low numbers dropping off, and half of it, I think, is due to real inflation. So my feeling, as I'll show you some graphs, is that this can go on for maybe another year to 2 years, as long as companies can pass on prices. And I know any of you that work in a manufacturing type industry are probably seeing input costs go up. And a lot of companies are trying to pass on those costs. I think they can do it for a year, maybe 2 years, but eventually they won't be able to keep passing on those prices. But no doubt inflation is here, and I think it's going to be here a little bit longer than the Fed anticipates. One input into the regular CPI is what I alluded to, the producers. What are they seeing? And these numbers, I've looked at the calculation, it's up around 7-8% year over year. So the producer price index is actually higher than the consumer price index. And mainly it's because of the commodities increased. I'll chat a little bit about the inventory shortage with computer chips that's affecting a number of industries, especially the auto industry. But no doubt, anyone who produces something is seeing a higher input cost. This is, I think, an interesting graph. It shows where inflation is and isn't. I mentioned the headline number, let's say, is 5.5% right now. But if you've tried to rent a car, you may have been in sticker shock. Let's say you went to Disney and tried to rent a car. Car rental prices are up around 80% year over year. Many used car prices are selling at a very minimal discount to new car prices. Conversely, I mentioned that I work at Rutgers in addition to Beacon/Provident, and we're not really raising any tuition, especially if you're teaching in a Zoom environment. Fortunately, we're going pretty much back to face-to-face, let's say for 90% of our classes. And there's obviously, a lot of concern, upset, you feel you're not getting the same value in a Zoom type environment. So it's kind of a mix. And that's where the inflation number comes up. But, oil prices have gone up dramatically over the past year. So we are definitely seeing some inflation. And I mentioned the used car prices up around 30%. So as I said, I think the Fed is kind of behind the curve. I listened to Jay Powell's remarks yesterday, and he basically said, we want to see unemployment numbers come down. Right now, they're, let's call it in the high 5 range. Before we went to the pandemic, it was 3.5%. So I think they're letting inflation run a little bit hot. I think, the Fed is a little bit behind the curve, but some of us remember, I certainly remember the 1980s. There was, certainly mid-single digit inflation with the oil embargo. Reading the history books, we know we had very high inflation. So why am I in the camp that inflation, let's call it an intermediate problem and not a long-term problem? Well, a lot of these shortages will end. Clearly you're making a lot of money selling cars or computer chips, or lumber prices were up for a while. So gradually the supply will catch up to the demand. So I think these shortages are, let's call it a 6-month bottleneck. You may have read about the infrastructure package that appears to now have finally worked its way through Congress. Well, the flip side is, how are we going to pay for it? So one of the things, or two of the things, is there's going to be higher taxes. Sadly, many of us on this call may be paying higher income taxes next year, and corporate taxes might be going up, maybe I'd say in the mid-20s, probably 25, 26%. That will put a damper on spending. The Fed, I mentioned a moment ago, they have not yet started to taper their purchases. I looked up taper in the dictionary the other day. Taper means reduce, doesn't mean completely stop. So by the end of the year, I think the Fed will say we're going to start to reduce our purchases. At some point later next year, they might stop purchasing. And then, and probably only then, I think they'll start to raise rates in late 2022 or early 2023. Another secular trend that's happening around the world is that the population is aging. You're all familiar with the data demographics on the baby boomers, but it's not just a US phenomenon. China has an aging population. You may have heard they went away from their one-child policy. You could actually now have 2 or 3 kids if you live in China. Japan has had a shrinking population, Italy, Europe. So there are some areas of growth, mostly the emerging markets, but generally, as the population ages, in general, you spend less. Now, clearly you spend more on healthcare, but you're not spending as much on other things, buying new homes and things of that nature. And I think all of us would agree, whether we like it or not, that technology is a bigger part of our lives, and it's probably going to continue, right? I mean, as a high school student, I read Thoreau and Walden Pond and said, get back to basics in nature. And I know a lot of people have that view as well, but Zoom, this whole pandemic I read has actually accelerated our adoption of technology by 5 years. Right, all of us are now pretty much proficient in these kind of Zoom type calls, as well as now ordering on Amazon. I order a bunch of things on Amazon. I order stuff at Walmart that's sent to my home when I didn't really do that in the past. And just to give you one example that I think many of us are familiar with and how technology can be deflationary, is that the Apple smartphone is about 12 years old. Now, before the iPhone, think about all the things you bought individually. You may have had your own digital camera. The iPhone is like a mini computer. It's pretty sophisticated, and I'm actually looking forward to there's an iPhone coming out in September, but the one next year is going to be the foldable iPhone, where you'll have twice the amount of screen. Samsung already has this, but it hasn't quite caught on. So bottom line, your phone is turning into a computer. I don't own a calculator anymore. Maybe in high school I did. It's a music player. I use this as an alarm clock. Years ago, I had this TomTom kind of GPS device. I don't have that anymore. It can monitor some of your health. I'm wearing an Apple Watch that's kind of ported to my phone. And yeah, last but not least, it is a phone, right? You can make phone calls on it. So this is a prominent example, but technology, because you can make it very scalable, tends to be deflationary. And that's another thing I think is going to keep a lid on this long-term inflation. All right, so that's kind of my discussion of the economy. I'm happy to address questions on the economy now or at the end. Otherwise, I'll just kind of move into my views on the stock market.
Anybody have any questions so far?
Right, so just moving ahead to the stock market, and feel free, as I said, you can jump at any time. I teach for a living, part of my living, so used to having people ask questions at any time. So with the stock market, I would describe it as the easy money has been made. I'm a little surprised how quickly and how we're actually well above all-time highs, right? The market is at an all-time high today. Stock market's up around 18% year to date. Those numbers are kind of shocking, given that we know that a lot of people, I'm sure people in all of our circles, are still having problems, whether it's small business owners or families or things. So I would describe it as I would favor stocks over bonds because you're getting very minimal interest on bonds. As I showed before, you're actually decreasing your standard of living if the CPI is at, let's call it 5%, and you're getting 1.5% on a treasury or less. So that dynamic and the fact there's a lot of savings is going to keep, I think, a buy on the dip mentality. But no doubt the stock market's expensive, as I'll show you on this graph here. There are a lot of ways to measure how expensive the stock market is. The most popular metric is the PE ratio. That's been in the stock tables of the Wall Street Journal for a long time. These are other measures looking at dividend yield and spreads. And so just looking at this, the average PE of the stock market over the past 25 years has been about 16.5. Today, that number is 21.5. It was higher during the internet bubble. I was more worried during the internet bubble. I was beginning my investment career at that point because we still have a lot of companies that still aren't having their full earnings. I mentioned some of the travel companies. So if you look out to 2022, the number is probably somewhere in the high teens. In addition, if you look at the companies, and I'll show you this on the next slide, that have a lot of these high PEs, Amazon, Netflix, these are real companies, unlike the internet companies that weren't really making any profits. So it may be the case that the FANG stocks just grow at a slower rate going forward, as opposed to there's some type of imminent collapse with them. But no doubt, stocks are kind of expensive, and this is why, I'm not super bullish. I mean, the money has to go somewhere, but I would definitely put it in diversified different assets, including real estate, which I know is expensive. There's more value in international equity than US equity at this time. This is another site you might want to bookmark. It's called FinViz, F-I-N-V-I-Z, and that stands for Financial Visualization. And this is what you call a thermographic or a heat map. And this specifically is a map of PE, which I had on the prior slide. So the average number for the market here is a little over 20. But if I look over here, I see pockets of value. So I think financial stocks are reasonably valued. We see companies like Goldman Sachs with a PE of around 10, which is less than half the market, JP Morgan. I think there's good value in the healthcare sector. I do know that there's a lot of pricing pressure on the pharma stocks, but that is a long-term growth industry with the demographics. If you're looking for dividend, you can get like a 4% dividend in Verizon. So this is why I kind of say it's kind of a market of stocks rather than a stock market. That if you look closely, and especially if you look on an international basis, I do think you can find some reasonable value. So as an example, supermarket stocks went up today, Albertsons and Kroger, because they're trading at a low valuation and people are still staying at home and buying things. This is a nice chart I like to show to our clients that reminds them to stay the course. And if you joined us a few minutes late, I was talking about what we did at Beacon Trust when kind of COVID first hit. And what I said was that we told our clients, okay, have 1 month of your living expenses in cash. And then besides that, let's just stay the course with your long-term diversified portfolio that tends to historically overweight equities. So what we see here is that during most periods, 75% of the time, historically, the stock market winds up in positive territory, but every single year there is a drop. Currently, the drop has been minimal. The largest drop we've had year to date, if you follow the stock market, has only been 4%. The average number, including bear markets, is 14%. The median number tends to be around 8% or so. So what I tell my clients is that the easy money has been made. We are likely to see more volatility, whether that's when the Fed says they're going to start, tapering their bond purchases, whether it's because of concerns about the Delta variant, who knows? I'm concerned about US-China relations. I have a little section on risks, but most of us on this call should be long-term investors. Usually equities are a good place to be long-term, but they are by their nature much, much more volatile. Not as volatile as Bitcoin, but they are much more volatile than bonds and cash. And that's why historically they give you those higher returns. So that's kind of like my little view on the stock market. If I had to put a number on it, maybe we'll get mid-single digits from here through the end of the year, which is fine since we were up around 17 or 18% as this call is speaking. Historically, the stock market returns around 8% when the valuations are, 10%. Historically, when the valuations are elevated like they are now, future 5-year returns tend to be, let's call it, a little bit below that, 7 or 8%. Moving on to the bond market, you might say, why do we have bonds at all? Well, they definitely serve as ballast to the portfolio. Somebody that does not need the income, I would suggest you underweight bonds. Bonds often go up when the market is panicking. It is a little bit surprising how the 10-year went from 2% almost to like 1.25%. If somebody has short-term expenses or obligations, you want to keep them in some type of fixed income asset, because we saw in March of April of last year, stocks fell 30% in 1 month. So, they're part of a diversified portfolio, but you have to look at what you're getting on an after-tax and after-inflation basis. And on that basis, I would not recommend a sizable allocation to bonds. As I mentioned, I listened to the Fed's minutes, a little bit on the press conference, and they basically said they are away from raising short-term rates. They are talking about stopping the bond purchases, which impacts the intermediate to long-term rates. But the soonest they will start the taper, I think, is September, more likely November, December. And I don't know if you follow this, but Jay Powell is coming up for re-election, so to speak. And I think if he wants to get reelected, he's probably going to be more slow to, aggressively tighten things. This just gives you some context. We often say the 10-year Treasury is a benchmark because a lot of corporate lending is 10 years, even though most of us may have a 15 or 30-year mortgage, the average person lives in their home around 8 years. Sometimes you move, sometimes you trade up, sometimes you trade down. So the 10-year, we call it a benchmark because it's tied, as I said, to the mortgage market, corporate lending. And in the context of long-term history, this number is exceptionally low. I would say 2% is probably a more reasonable number for these times that we're currently in. And then when the Fed starts raising rates, maybe 3% might be a more normalized number, but it's still low. All of us that have a mortgage, you've probably been able to refinance it and get a pretty attractive rate. You might be wondering, and I get this question from investors, why are our rates so low? Especially given that I've said that we're out of the recession and the stock market's at an all-time high, real estate's at an all-time high. Well, let me hit some of some of my thoughts. One is that the Fed is still buying bonds, right? So they basically stapled short-term interest rates like Treasury bills to zero. So what the Fed does is it has a portfolio of securities. That portfolio, amazingly, is now $8.5 trillion. Just to put it in context, before Lehman went bankrupt and the whole Great Recession started, the Fed's balance sheet was about 800 billion. Now we're more than 10 times that, and they're still buying. So the number is going to get over 9 trillion. This is one among several reasons why I think there's some interest in Bitcoin, which we can chat about. I think Bitcoin is real, but we don't have any meaningful client assets in it, at least on an aggregate basis. So number one, the Fed is still buying bonds, and just from a simple supply demand, it pushes down yields. There is some real concern, and I was chatting a little bit with Mr. Feinstein about what he's seeing, that the Delta variant is coming back. We're seeing rising numbers. We saw that in the UK, where they had to basically shut down the country again for a little bit. And so that's certainly crimping economic growth. The sooner we can all go outside without a mask and get on an airplane and eat in a restaurant, the better the growth will be. And one thing to be aware of is that we live in a global world. I mentioned I see more value outside the US. The US 10-year Treasury is 1.25%. I think all of us remember about 5 years ago, the headlines of Greece in the news maybe potentially defaulting. So amazingly, if you bought a 10-year Greek bond today, I don't know why you do it, but that number is 0.7%. You're getting half the yield on the US for a Greek economy that I would argue is not nearly as strong. Rates are low because everything is pretty much expensive. I mentioned the stock market at an all-time high. Real estate, as measured by the Case-Shiller Index, is up 14%, 15% year over year. So everything is expensive. And people say, okay, when everything's expensive, I'm still going to own some bonds. Another thing that's happened is that the rise in asset prices has, in a positive manner, made many pension funds close to fully funded. New Jersey is making some slight progress, the state, but companies, I think, have made very good progress. So when your pension fund is fully funded, you tend to shift to annuity type investments that lock in your actuarial rate of return. I don't know if I have a chart in my slide deck here, but I have other charts that show that investors are still saving at a high rate. I know that because I'm not able to fully go on vacation and do other things, and I'm personally not buying a car on purpose because the prices are so high, I'm saving more than I did over the prior couple of years. So that savings has to go somewhere, and some of it is winding up in the fixed income markets. Not only that, companies are at record profitability. We've seen excellent earnings from Apple and Google. There's trillions of dollars in cash on the sidelines, and some of that winds up in fixed income type investments. So all that's keeping rates low, but my view is that rates are going to drift up higher towards that 2% range, as we go towards the end of this year and into next year. And this is kind of the last slide I have, and then happy to have a discussion. There are always risks. There's never a time in the market there's nothing to worry about. You've heard the market climbing the proverbial wall of worry. Here we are at an all-time high in stocks, real estate, many other things, and yet we have this pandemic that only happened 100 years ago. So one is that the vaccines are not as effective against some of these vaccinations. There is concern that enough people are not being vaccinated to get that critical mass or immunity. Things are expensive in most risky asset classes, whether it's stock, real estate, private equity. There is going to be an increase in taxes, whether we like it or not. That's going to have to pay. There are some trade tensions between the US and China. That may be getting worse. Even if you don't have direct exposure to Chinese stocks like Alibaba, the supply chain is tied to China, even though we're trying to diversify away from that. And even stocks that many of us own, like Apple, a big part of their growth is from China. Starbucks is big in China, General Motors. So that relationship is probably the biggest macro risk once we eventually get past the vaccinations and other things that COVID is putting upon us. These cyber attacks are concerning, especially attacks on the financial system. You've all heard of these companies in the financial news that have been held up for this ransomware. I'm not in this modern monetary camp where you can print unlimited money and not have to pay that back or have it result in higher rates. So these huge budget deficits currently in the $3 trillion range will eventually have to be repaid. And the most likely scenario is we'll see a cut in entitlement programs. So one example is that there could be means testing for Social Security, where the cost of living could be below inflation. The co-pays could rise for things like Medicare and so forth. So I think we're gonna have to pay these things back, and it might be difficult. I have a teenage son and their taxes might be higher. There's always geopolitical risk. I mentioned Russia and the cyber attacks. China, Middle East is always a hot spot. So those are some of my remarks. I think, I don't see any sign of a recession. I think that the easy money has been made, but that the global economy will gradually get a handle on COVID through vaccination diplomacy. One thing I didn't mention that I do want to mention now is that the vaccine is in the process of being moved from what we call emergency or experimental status to, let's call it, fully approved. And that change in designation is giving companies the legal comfort to now require their employees to get vaccinated unless it's some kind of health issue. So as an example, Google and Facebook have both announced that their employees are going to be required to be vaccinated by October. As I mentioned, schools have already mandated that. So that kind of, to place it harshly, somebody might say, if you want to keep your job, you got to get vaccinated. That would get a lot of people on board that are currently hesitating. So let me just kind of pause. I'm happy to kind of address anything on your mind related to those three big topics: economy, stock market, or kind of fixed income.
Great. Thank you, John. Does anybody have any questions? Jack, what did you think?
Well, I was actually happy I listened in because, John, you're more optimistic than I am, I'll be honest. So I think this is good. And you do it for a living and I don't. So that's even better. So yeah, I appreciate it. I just think we're, in for some ups and downs. And I think the point of if you hang in and, keep a long view, we should be okay.
Yeah, just to follow up on that comment, Jack, we are seeing a little bit of a preview of what might come in like UK and other countries that are dealing with these, let's call it second wave for us. So my view is that we will have these spikes. They will be more regionally focused. There might be masking short-term things, but the ship has sailed, so to speak. The economy cannot be shut down en masse again. And as we continue with the vaccinations, whether by choice or force, so to speak, that will get us towards the herd immunity gradually.
Hey, John, one thing I noticed that was not on your inflation list, or I missed it if it was, is restaurants. And I don't know, I've noticed like a huge increase in prices in restaurants for everything from appetizers to entrees. And I mean, I assume a lot of it's driven by the labor shortage, and maybe there's supply shortage as well. But, related to that, like, with the COVID kicking up again, and the labor shortage exists right now, do you think that the COVID unemployment relief is going to continue on? And what's going to happen with the labor market?
Yeah, good question. So just to expand on your comments, on the restaurant, there's two things that are happening. One that you alluded to is that they're having a hard time finding workers, and to get some of those incremental workers, you have to raise rates. Two, I did allude to commodity prices. So food is obviously one of the elements of commodity prices, and they've gone up quite a bit as well. So that's driving it. Sadly, we had quite a few number of small businesses, including restaurants, go out of business. So those that are left do have the power to raise prices. So all of that, I think, is seeing a bump, and they tend not to cut prices. So I think we are seeing, let's call it a more permanent uptick in restaurant prices. So in terms of labor, we're seeing more and more states. New Jersey currently is not in the bucket. It tends to be more the southern states that have ended that extended unemployment insurance. The big thing to me is like, will people be able to go back to school normally? Because, I'm a parent of a teenager now. He can pretty much handle himself. But, for people that have young kids, they can't go back to work if their kid is being taught in a Zoom environment. So that, I think, is a big thing, that kids are able to go back to school. Then I think we'll see a lot of these unemployment benefits at the other end. But no doubt they are gradually ending on a state-by-state basis. But New Jersey is, I think, in the more generous bucket at this point.
Thank you.
I guess at a restaurant, if you want to save something, you could just maybe eat out. I mean, you could order out and either have it delivered to your home or just do takeout, and you could avoid the service charge. But obviously, some people just like the enjoyment of eating in a nice location with their friends.
John, you mentioned the acceleration of technology by 5 years. Could you elaborate on that? I mean, clearly we're on Zoom now, but how does that impact productivity? Do you think that will displace workers or will also create some efficiencies?
Well, I think this kind of working from home environment is going to be a new permanent part of the landscape. So at Beacon, even before COVID hit, we were experimenting, let's call it this hybrid type learning, where you're in the office, let's say 3 or 4 days a week, and working from home 1 or 2 days a week. I think this is going to be something that the majority of companies are going to have to offer, because I think people like the flexibility. And so that's one thing. So Zoom is here. I think it makes travel a little bit less. So with most of our clients, let's say we meet them twice a year. Maybe now once is face-to-face and once is Zoom. So, at Rutgers, we have faculty ranging from 20s through 80s. And not to stereotype, but generally, let's say the people in their 80s are maybe not quite as proficient with teaching via Zoom format. We were all thrown into this and had to learn on the fly. So that kind of acceleration has happened. And so I think even just other acceleration. Your car, in case you haven't noticed, is turning into an iPad on wheels, right? So the electric vehicle is primarily more technology oriented. So it's really permeating the entire supply chain. And the thing about technology, it happens very quickly, right? So I mentioned the smartphone. 12 years ago, nobody had a smartphone. Now almost everyone has it. So there's all sorts of things in it. You kind of, Malcolm Gladwell has this thing, the tipping point, that once you reach a critical mass, you hit that. So, but you know, I like to go outside and hike and enjoy nature. And I did a weekend trip to Stowe, Vermont with my wife. And if you've ever seen the movie The Sound of Music, the Von Trapp family, when they relocated to America, they went to Stowe, Vermont. So there's some very nice scenic hills and things there that somebody can do. They want to unplug from technology.
John, this is Trish O'Keefe. Very informative presentation. Thank you so much.
Thanks, Trish.
A quick question for you, and maybe it's too early, but are you seeing any trends from a change in retirement age? And maybe it's just due to the segment that I'm in from a healthcare standpoint, that we are starting to see some trends in people retiring early. Probably the nature of our business over the last 2 years, but anything you're seeing from your perspective?
Yeah, I'd agree with that, Trish. I think I read a survey, and this might be concerning for people on the call that are running their own business. Up to a third of people are considering either leaving their job, whether that's due to retirement or just considering another profession. I do think that the pandemic has created a lot of soul searching. If you were able to remain invested and had the stomach to ride it out, your portfolio is probably at an all-time high, which, you know, like I said, I'm not surprised at the recovery. I'm surprised at the speed and maybe the magnitude of it. So I think this, let's call it bump in wealth, has given people reason to, you know, be a little bit more, you know, open-minded in what they want to do. But, you know, I think some of these generous benefits that will eventually go away or may also eventually, you know, move in the opposite direction. But no doubt, I think we are seeing more people retire or have a second job, a second career. Where, you know, when I go on vacation to some of these tourist resorts, I always run into like a former Wall Street person that opened an ice cream shop or bed and breakfast or something that they more enjoyable. So let's call it maybe a transition in the type of work and not the grind that a lot of us tend to do.
Sure, thank you.
My pleasure.
John, when we hear from real estate
professionals,
you know, they often say that it's probably going to take another, I mean, we had a real estate event back in December. So now we're about 7 months from that. And at that point, they said they were looking at 18 months to 24 months to really start seeing decisions that CEOs were making and how that would impact the real estate sector. And you mentioned real estate as a potential investment for some folks. Are you seeing that long runway? There's still decisions that will still be made over the next year or two.
Real estate's a huge category. So we're clearly seeing a lot of continued investment in the industrial/warehouse space. I alluded to Amazon. I live both in New York and New Jersey. I'm doing this call from my New Jersey home and not too far from exit 8A, which is halfway between New York and Philadelphia. So a lot of warehouses are being built there. But on the other side, companies are looking at their real estate footprint. That I mentioned that if people are working from home more, they may need less commercial space. In terms of residential, there's a tight inventory. So I think what we saw is that we saw a lot of, let's call it affluent people that may be living in the city that wanted to have a place in the suburbs because of the whole COVID pandemic. There was also a moratorium for a while on not being able to raise rents and things. So gradually, I think, you know, these huge price increases we've seen, double digits, I think are going to more normalize to the typical 3%, 4%, 5% as more inventory comes on the market. But, you know, there are very few people that said, okay, I have a large home that I'm going to sell, and I'm going to sell that home and move into a city worried about the spreading of COVID. So I would just say there was a bump in demand and the inventory is slowly catching up with that. But, you know, I would certainly say real estate could be part of a diversified portfolio, especially if that is a cash flow positive type investment. For the average person on the street, you could use real estate investment trusts, but they have stock market type volatility. But yeah, if I had to place it, I'd say industrial will continue to do well. Corporate, maybe not so well unless you're in these areas like Amazon moving to Virginia. That could spur, a whole ecosystem around that area.
Interesting. Any other questions before we sign off? John, one last question. You mentioned the last slide, you listed risks.
Mm-hmm.
Do you ever rank them or give them extra weight, or if there's one risk over the other?
Yeah, years ago, we used to publish this thing called the risk list, but I would describe, the whole expansion of COVID with the Delta variant and, vaccinations or lack thereof, the path of the pandemic is the #1 near-term risk.
Okay.
I do think it's, a risk that will gradually dissipate by next spring, let's say. And the #1 risk that I think would have a bigger impact on your financial pocketbook, so to speak, is that China-US relationship, because of the supply chains, because of the fact that a lot of leading companies, like I alluded to, like Starbucks, Apple, GM, they're getting a lot of their incremental growth from China. It's pretty clear. And I think there's a positive element that we're trying to rebuild our supply chain. So for example, Intel is now doing manufacturing of chips for other, computer companies. So I do think it's good that we are re-engineering our supply chain, but still the bulk of the supply chain is out there in China. All the stuff we buy at Costco and Walmart, a lot of that is still manufactured in China. I am a little concerned with the Russia relationship. Russia, just to put it in economic terms, is around the size of Italy. So I think they're more, significant from the whole military perspective. And I do think these cyber attacks are not going away. People have found a way to extort and get ransom. This is one of the downsides of these cryptocurrencies, that you can, get the money in that fashion. And, I don't know how much control Putin has over these hackers. Maybe a little bit control, but not all control. And they can see they're making a lot of money from this. So I don't think that's going to stop. And knock on wood, I work for a bank. There has not been a major breach of a, like a Bank of America or a, JP Morgan. If that were to happen, that would be very concerning.
Well, thank you for sharing your insights with us today. And thank you all for being with us, and have a wonderful rest of your day. John, do you have any closing thoughts?
No, my pleasure. I'm happy to, share my contact information. Megan can send my email, and happy to meet up for lunch one of these days once, we get back to normal, so to speak. And Beacon Trust is in Morristown, and Rutgers, is New Brunswick. They're in Newark as well, but I'm also happy to meet people on campus if you want, and give you a little tour of the campus. And we have a nice place for lunch there as well.
Wonderful. All right. Thank you. Jack, any closing thoughts?
This was enjoyable. I appreciate it. I think you, when you sit back and listen, though, there's just so much going on, right? And there's so much uncertainty, and how we manage through it's going to be interesting.
Great. Well, my pleasure, and, happy to do it. And thanks for having me, and, enjoy your weekend, which I know is coming up soon.
Thanks, John.
Thank you, John.
All right.
My pleasure.
Thank you.
All right.
Thank you.
Bye.